Textbooks call US Treasuries risk-free. History says otherwise. Sovereign debt carries real risk, from Russia to Greece to the United States. Today we test the risk-free myth against defaults, debt dynamics, and market signals. In finance, the risk-free rate is the foundation of every model. It is the return you can earn with zero default risk, and it anchors the pricing of stocks, bonds, and derivatives. Textbooks point to US Treasuries as the perfect example. But this is a simplification. The risk-free rate is a theoretical construct, not a market reality. Every asset carries risk, and sovereign bonds are no exception. The question is not whether they can default, but when and how. History provides the answer. The risk premium is the extra return investors demand for taking on risk. For a sovereign bond, it is the yield minus the risk-free rate. If a bond yields 5% and the risk-free rate is 3%, the risk premium is 2%. This premium compensates for default risk, inflation, and currency devaluation. When markets sense trouble, the premium rises, pushing yields up and prices down. The formula is simple, but it captures the market's fear. In 1998, Russia defaulted on its domestic debt. The shock rippled through global markets and triggered the collapse of long-term capital management, a hedge fund that had bet on convergence of bond spreads. LTCM used massive leverage, and when Russia defaulted, spreads blew out, causing losses that threatened the entire financial system. The episode proved that even a major sovereign can default, and that the risk-free assumption can be fatal. Argentina defaulted on its sovereign debt in 2001, its ninth default in history. The country had pegged its currency to the US dollar, but fiscal mismanagement and external shocks made the peg unsustainable. When the default came, it wiped out investors and plunged the economy into crisis. Argentina's repeated defaults show that sovereign risk is not a one-off event but a recurring feature of some economies. Debt dynamics determine whether a country's debt is sustainable. The change in the debt-to-GDP ratio depends on the interest rate, the growth rate, the primary balance, and the initial debt level. If the interest rate exceeds growth, the debt ratio tends to rise, even if the government runs a primary surplus. This is the snowball effect. For the US, with debt above 120% of GDP and rates high, the snowball is turning. In 2012, Greece restructured its sovereign debt, forcing private creditors to take a 75% loss on the face value of their bonds. This was the largest sovereign restructuring in history. The Greek crisis showed that even within the Eurozone, sovereign bonds are not safe. The restructuring was a coordinated effort to avoid a full default, but it still imposed massive losses on investors. The lesson: sovereign risk can materialize even in developed economies. In 2022, Sri Lanka defaulted on its sovereign debt, becoming the first country in the Asia-Pacific region to do so in decades. The default was driven by a combination of foreign exchange shortages, high debt, and an economic crisis. Sri Lanka's default underscored the vulnerability of emerging markets to external shocks and fiscal mismanagement. It also showed that sovereign risk is not confined to any one region. The United States is not immune. As of recent public information, the US debt-to-GDP ratio exceeds 120%, and it continues to climb. In 2025 and 2026, repeated battles over the debt ceiling have brought the government to the brink of technical default. These episodes have already caused market stress. In late 2025, Moody's reportedly warned that if fiscal discipline is not restored, the US sovereign credit rating could face downgrade pressure. The risk is real. A credit rating downgrade affects the risk premium. The yield on a sovereign bond is the risk-free rate plus a spread that reflects credit risk. If a rating agency downgrades the country, the spread typically widens, raising the yield and increasing borrowing costs. The formula is simple: higher risk premium means higher cost of debt. This can create a vicious cycle, as higher interest costs worsen the fiscal position. The textbook view treats US Treasuries as risk-free, but the market reality is different. In the textbook, the risk-free rate is constant and known. In reality, it changes with market conditions and reflects sovereign risk. The comparison shows that the risk-free rate is a theoretical benchmark, not an actual asset. Investors must recognize that all sovereign bonds carry some risk, and the premium they demand is the market's judgment. Sovereign bonds are not risk-free. They carry default risk, inflation risk, and currency risk. The risk-free rate is a useful theoretical tool, but it is not a real asset. History shows that even the most trusted sovereigns can default or restructure. For investors, the lesson is clear: always demand a risk premium that reflects the true risk. Understand the debt dynamics, watch the credit spreads, and never assume safety. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.